Okay, I think we'll get started. Thank you for being here tonight. For me, it's afternoon. I'm on the West Coast. My name is Justin Kribs. I'm with InsMed, and thank you for being here for the very first webinar of a series of webinars focusing on, what you call financial literacy, financial wellness, really kind of a baseline webinar series on essentially establishing a foundation for personal finance. And this is something that I have been doing for quite some time. This series is brought to you by Financial Beginnings, which is a nonprofit financial literacy group out of, well, essentially my backyard, Beaverton, Oregon. Joanne, our other moderator on this webinar, she's the program manager out of California. And again, my name is Justin Kribs. I'm with InsMed. And today is going to be, for some, very basic. For others, this is going to be the very first time you've heard this information. Um, Myself, I came from a background of academia. I used to work at Oregon Health and Science University, where I essentially spent a lot of time helping people understand the transitions, the financial transitions that would happen as they went through their careers in medicine. And you'd have people, of course, transition through medical school, transition into residency, out of residency, into being an attending, and then also all the changes that go along with that. And there's never really a bad time to either get a refresher or be first introduced into the topics of saving and retirement. A lot of people, when you talk to, of course, a medical student, excuse me, you start talking about savings and retirement, it's kind of one of those, it's not a thought right now. It's not something that's going to be on step. It's not something that's going to be on a shelf exam. You typically don't have you know, your program coordinators or anybody else talking to you about retirement planning or savings as you're in school. It's not part of the didactic program. And of course, during residency, it's not really a part of the clinical experience. Yes, you might get several people will come and talk to you, give some lunch and learns. Maybe there's a grand rounds about it, but really, it's not a topic that is often discussed. Now, for some of you, it might be very familiar with this topic. You've had plenty of experience. You've had exposure to it. Maybe somebody in your family has taught you about finance. Again, for others, this might be kind of your first dive into it. And so hopefully there's something here for everybody. That's the goal, is for somebody to, or for everybody to get something out of it. And so we're going to kind of get going here. Little housekeeping very quickly. There is a chat function that's part of this, so you can chat. And then if there's any questions, please feel free to unmute yourself and ask if you would like to. Everyone's muted right now, but you do have the ability to unmute yourself. You can also tell the host and co-host, hey, speed up, slow down. Can you repeat what you just said? So you do have some ability to interact. I'm used to giving a lot of in-person lectures. I'll fly over the place and give lectures to institutions. So me sitting in actually what is my youngest daughter's bedroom, this is my office right now, it's a little different. So instead of me walking around, I talk with my hands a lot. So you'll see this kind of fly up in front of the camera there. So anyhow, savings and retirement. So when you think in terms of finance, we look at it in terms of what some will call life cycle theory. And when you're thinking about the life cycle, you're thinking about, okay, what is the cycle of a person's financial picture? Of course, when you're thinking about it in terms of student, medical student, dental student, PA, nursing, or whatever, you are accumulating typically debt while you're in school, while you're training. And then as you move along through your careers, you start increasing savings, debt goes down. And then of course, as you go into retirement, your savings goes down. And if you talk to a financial planner, whenever we talk about in terms of our projections, all of our projections are always you die with no money. You develop savings over time. Debt goes down, savings goes up, and then you spend to retirement, and then when you retire, there's nothing left over. That's what they call your life cycle. And everyone's cycle starts and stops and changes differently based on your situation. I never talk about it in terms of like everyone's the same. We all know that not everybody is the same. Not everyone in your class is the same. Not everyone in your department is the same. You might have the same title as somebody else, but your circumstances are different. And you can talk in broad general terms, and we will talk in some broad general terms, but you also have to think about it in terms of like, how does this apply to you? It's very easy to talk about numbers just as numbers, but what do those numbers mean to that individual? You know, when people talk about retirement, what does retirement mean to you? That's gonna be different than retirement to somebody else. Probably my personal favorite definition of retirement has always been doing what I want to do when I want to do it. You know, I want to keep working. I'm working to retirement. I want to go live on the beach. That's my retirement. I never want to stop doing what I'm doing right now. And to me, that's retirement. You know, it's always going to have a different meaning. And of course, depending on your situation, you know, how do you start setting yourself up for retirement? How do you start setting yourself up to take care of all these other things that people always talk about? Um, you know, you hear people talk, especially nowadays, with what's going on when you talk about student loans, which is something that I spend a lot of my time talking to people about, is loan repayment and how do you deal with loan repayment in terms of balancing that with everything else in life. Um, you know, I'm used to talking to people with, you know, six-figure debt. And how do you talk about, okay, when should I start saving for retirement versus should I pay down my loans first? You know, should I even worry about setting up a retirement plan now? Why don't I just wait until everything's paid off? And I've seen a lot of course, different arguments about it. But the thing that I like to always remind people of is that when you're talking about your timeline, you have to start your savings timeline as soon as you possibly can. And that comes down to the simple aspect of what is known as, of course, compound interest. I mean, you think of it in terms of, again, with loans. You take out a loan, interest accumulates. The sooner you take out a loan, the sooner that interest starts accumulating. Well, with retirement savings, the sooner you start saving, the sooner you start accumulating wealth for later. And when you think in terms of, okay, you know, why don't I just wait now and I'll save more later? I've heard that a lot. I've heard people say, okay, again, going back to loans, I'll pay down all my debt right now. I'll pay off everything right now and I'll save later. I want to pay off my mortgage now. I don't want to have any debt now. I want everything, you know, I want to make that my situation. I'll save later. Okay. So if you're thinking about saving later, there are repercussions to doing that because the longer you wait, the more you have to save. So in this example right here, you have a person who's going to say, I'm going to save $200 a month for 10 years and then stop, versus a person who will wait, then save $200 a month and continue for a longer period of time. And this is when it comes down to the idea of compound interest. A person who starts earlier will always be better off than a person who starts later. Of course, if you say you give it a finite rate of return. Of course, a person who starts earlier and they're earning 3% rate of return, they're not going to do as good as a person who starts later and gets like a 25% rate of return. However, from my standpoint and from my experience, you never think in terms of, oh gosh, what if I get 10% return? Or why don't I just wait later? I'll just get more risky with what I do. And that is something that you always have to keep in the back of your mind. How much risk are you willing to take as you're trying to save? And again, going back to the idea of retirement and trying to save for that future, it's easy to look at your situation now and think, okay, this is my situation tomorrow. This is finite. This will not change. I'm okay with my situation now. I'm able to handle what happens now. However, when you're looking into the future, you also have to think in terms of inflation and how will changes in the costs of goods and services today affect my future for tomorrow. Of course, this is leading back to the idea of when do you start? When do you start? You know, what is a good time? And I always go back to the good time is always better to do it now than wait till tomorrow. And of course, it's easier, as resources become available. As a resident, you don't have a lot of resources available to you. You have a lot of competing needs and wants and desires, and you have a lot of, responsibilities that you need to take care of. Of course, the economic situation is different. Versus as you transition on through your career, things start changing. The idea, of course, is to try and set yourself up to where as things change, you don't let things like spending creep get in the way. Of course, here the example of how about inflation? You think of something, well, when we used to go to the movies, um, right now the movie theater is in the living room. Just the idea of like, what will it cost for me to go do what I wanted to do now, but also look into the future. So when you talk about a retirement plan, you're not talking about, okay, what are just my costs of living today, but what are my costs of living tomorrow? And there's things you have to keep in mind. Like today, you might have a mortgage, you might have your loan payments, you might have a car payment. Maybe you're saving for college for your kids, but in retirement, how many of those expenses are you removing from the scenario? And that's something I like to have people always keep in mind is that, your situation changes over time. Always look at what you have going on right now, but how will it change in the future? And what are the things that you enjoy doing now that you want to do tomorrow that you should be saving for? Of course, you have Einstein, who has a great saying about this, eighth wonder of the world. Um, so true. So true. And when you think about, all right, I have all these competing responsibilities, there are programs out there that help us with so many different things. Yet there is no program out there that helps you with retirement, with long term. Eventually that day will come. And when that day does come, how do you transition into it? How do you set yourself up to transition into it? And then people say, okay, well, how much does it take to start saving for retirement? Well, again, that's going to be different for everybody. One easy rule is Rule 72. How much will an account change over time? And the simple rule is take 72, divide it by whatever your rate of return is, and that will tell you how much time it'll take for you to double your money. And in this case, a person at, I believe it's 8% return here, goes from, 5,000 to 10,000, and then eventually goes 40, 50, 60, or sorry, 20, 40, 80, 160. So the money keeps doubling over time. Of course, that's with a constant finite number in the world of a spreadsheet where things never change. But of course, life changes. I think COVID-19 and the impact on the market. That's also it is also an easy way of understanding, okay, well, what is a reasonable rate of savings? What is it that I'm trying to accomplish now? How do I inflate that into the future? Look at all these things that I want to do. How do I set myself up so I can do them? And as you look at your situation, it's trying to look at all that noise, look at all those options and say, okay, what makes sense for me? And I'll spend a lot of time talking to people about that as well. What makes sense for you? What is it that you are trying to save for? What is it that are those goals? Of course, you start thinking about, okay, what is my long term? What are my goals? How do I transition out of this? What in this stage of my life, how does it lead to the next? And so those are ways of thinking about it. That's the philosophical, the behavioral finance ideal behind it. And never ever, think that again, your idea is wrong or that your idea should be the same as somebody else's. No, your idea is your own. Everyone has their own needs and wants and desires, and everyone else has their own relationship with money. That's very true. Everyone has a different experience with how money has affected them in their lives. Well, that's probably actually that's one of the reasons why I do what I do today. Is the fact you have a very you have a very interesting relationship with money and your history with it, and then how do you help others have a better history? So when you're thinking about, okay, how do I get from point A to point B, there's the idea about how to do it, and then what is it that you have to look at, and like how do you invest to do it? What are the different vehicles that are available to you? And of course, there's a lot of terminology that's thrown around, especially with investments. You have stocks, bonds, mutual funds, exchange traded funds, variable annuities, life insurance. I mean, there's tons of products out there. You think of it, and I guarantee you, the financial services industry has thought of a way of monetizing it or creating an investment around it. Again, going back to student loans, there are student loan asset-backed securities, also known as slabs. So there's always something. So probably the most commonly talked about investment is a mutual fund. And a mutual fund is essentially a fund of funds. When you look at your retirement account, especially with an employer retirement account, you have your retirement account. Let's call it a 403B. Within that 403B, let's say it's with Fidelity, just to throw out a name. Within that Fidelity 403B, you'll probably have either a choice of a portfolio for you to pick or a list of investment options to choose from. All those investment options will likely be mutual funds. And so mutual funds are a fund of funds. So you have what might be known as a balanced fund. And a balanced fund will essentially be an investment. You can buy a mutual fund, one share of a mutual fund. And with that one share of the mutual fund, you will own a fractional share of whatever that mutual fund is made up of. You might have heard the term the index funds. Essentially, a mutual fund is a mixture of different investments. So instead of you going out there and buying 500 different stocks, you can buy one share of a mutual fund, and that one mutual fund will have a fractional share of 500 different stocks. You hear the term diversification. Well, you can either diversify by buying a whole bunch of different stocks and bonds, or you can buy one mutual fund, and within that mutual fund, you'll be diversified across multiple different investment types. And so a mutual fund can either be actively managed or passively managed. So actively managed, there is a money manager that is always making changes within that fund. It is actively managed. Part of the internal fees of a mutual fund pays for that manager. And that manager essentially picks and chooses the investments, and the performance of that mutual fund is dependent on their decisions. Passive, one and done. They make their portfolio, that is it, over and out. ETFs can be an example of a passively managed asset. It's not a mutual fund, but it's another idea of we created the portfolio will never deviate from this. And when you buy this mutual fund, this is what you're always going to buy. Now with mutual funds, there are of course the fees associated with the mutual fund, what I call the ABCs of mutual fund investing. A shares, B shares, C shares, and then there are no load fund shares. And then of course, depending on which fund family you're talking about, there can be your Admiral shares, your R shares, your F shares. They're always coming up with some different alphabet for the shares. But To keep it simple, most investors will come across A shares, B shares, and C shares. Easiest ways of thinking about that is what the additional fees are associated with a mutual fund or with that mutual fund. If you have an A share, so a person tries to tell you, hey, you should buy A shares. With those shares, there is a upfront load or an upfront cost of buying that share. So let's say one share of that mutual fund is $100, but there's a 5% fee for buying that share. So if you bought that share, you would only buy, if it was 5%, then you buy 95% of that fund because your $100 didn't buy $100 of that share, only bought 95. We have a question. With active management, what is a reasonable percentage it will cost to manage them? Great question. So when it comes down to the percentage for the management fee is usually associated. It's typically based on basis points. I'm going to show a website where you can find that information. So every fund family, every fund will have its different management fee. And you want it, of course, to be less than 1%. And that fee, that management fee, will vary by fund. Usually it's 0.25% or, 0.1%. So it's something small, but when you're thinking about a fund that has, $100 million under management, that fraction of a share can be several $1 million for that fund manager. So a B share, and you never see B shares these days. They're kind of an old share. If you ever see a B share, you never buy a B share because B shares are the most expensive type of share. There's no cost to buy it up front, but there is a cost to sell it. Also, the internal fees are higher with a B share. A C share. Oh, will this discuss pros and cons of active versus passive management? Oh yeah, definitely will be. So the question was, will this discussion also go over pros and cons of active versus passive investment management? Yeah, definitely talk about that. And so level load is a C share. It's 1% all the time. It's level. And then a no load is just as it says. There's no additional fee for buying or selling that mutual fund. And so you have something like, you hear a lot about Vanguard. Vanguard has no load funds. There's no load to buy it or to sell it, but there's always a fee to own it. That comes down to the management expenses. So all mutual funds have internal fees. And a great tool, if you ever have somebody come to you and say, hey, here's a portfolio you should look at, here's something for you to take a look at, here's what I think you should do, etc. There's something called the Mutual Fund Analyzer. See if I can get this to pull up multiple times. And this is a federal or governmental website made by FINRA. And you can type in here any fund. So you can go, all right, let's say nationwide. We'll go like nationwide fund family. And it'll pull up all the different nationwide funds. And you can say, okay, we'll do this. We'll click that. Then you can go, okay, let's go Fidelity. And we'll click that. And then you just hit this button down here. It says Analyze. And it will tell you, what are the total fees? What are the costs for owning this? And in this case, Fidelity is to own this fund. It's more expensive than owning this fund. And you can do this with ETFs, really anything. And this is why I talk about being an educated consumer, as you'll always hear lots of noise about what you should do, but you never hear a lot of, talk about what it will cost you to do it. And there are always those internal hidden fees. I'll talk to medical students about the hidden costs of medical school. Okay, well, hidden costs of investment management or investing in general are going to be all of the fees. Even if somebody says, hey, no commission trades. Okay, well, there's a cost associated with that where they make up that money. And to the excuse me, to the point of active or passive management. Let's go back to our slideshow. So with passive or active management, this is where it comes down to the idea of, all right, when you think about active management, you think about people who are making trades all the time. You know, when you think about active, I guess, how much activity are we talking about? You know, when people have, you know, when you see those, the commercials about TD Ameritrade or all these platforms that will tell you how to trade and when to trade and what to trade. I guarantee you that you will not get the information any sooner than the companies, the professional financial management companies out there that get that same information, but they trade in nanoseconds, always going. And while you are there trying to decide if a stock is a buy or a sell, because of what Motley Fool wrote or what you read, the latest blog, that decision has already been made by another entity. And the stock market price that you are seeing in front of you is based on the information that you just got that they got beforehand, just a little bit sooner. It might come out on the same day, but their algorithms already handled that. When it comes down to active management, if you have a well-created, if you have a well-designed portfolio, the idea that you'll have to go in there and make trades all the time is, you know, not very likely. You won't have to go in there all the time and make trades. With an actively managed mutual fund portfolio or actively managed mutual fund, that fund manager will have their prospectus that will outline how they need to manage that fund. And depending on what happens within the industry that that mutual fund is focused on, that will make the, you know, that will decide how that manager should react. Also think of a mutual fund as a freight train. Okay? Because with the mutual fund, as the mutual fund gets bigger and bigger and bigger and bigger and bigger, it's hard to stop. Think about the financial crisis of 2008. You had mutual fund managers that were managing mutual funds that were so big that in order for them to make a change, it would have an adverse effect on the fund. So the stock market works in the terms of supply and demand. A lot of investors want this investment, but there isn't a lot of that investment out there. There is a finite number of shares for every stock that's out there. Think Amazon. Everyone wants to buy Amazon, therefore the price of Amazon goes up. Okay, well, at the same time, let's say that everyone doesn't want Amazon anymore. Like people like sell Amazon, it's horrible, it's going down. Okay, well, if you are a large owner of Amazon and you want to dump your Amazon shares, because you are dumping your shares when there is low demand but high volume, the price of that share just starts plummeting. To where if you dump everything that you have in that investment, you're hurting the overall return of that entire fund. So in terms of active, passive, with a mutual fund, you hope that mutual fund manager, in my opinion, should be active in terms of, are they paying attention to what's going on in the market, especially by perspective they should. By perspectives they should. If it is what is known as an index fund, which will only, like, say the S&P 500, it is only invested in the 500 stocks in the S&P 500. Well, that doesn't have to be actively managed unless there is a change in the number of, in the makeup of the S&P 500. Now, you as an investor, I don't believe in day trading. I don't believe in, you know, looking at your portfolio and making a trade every day. You're chasing returns. And I've yet to see a scenario, and I've been in this industry since what, 2003, where there is an active manager out there that by them buying and selling every day, they did a great job. Now, maybe you're able to do that, but when you think about your portfolio and what you should do, there's always the idea of purchasing what makes sense and managing and making changes as things change, as the situation changes, as life changes. I mean, think about everyone back in 2008. We had a lot of clients that said, "Okay, get me out of the market. It's at 8,000 points. I'm going to buy a fixed rate. I'm going to buy CDs, liquid everything. I'm going to be in CDs until perpetuity." Okay, well, the market went to 8,000, and what? It peaked at 30 before the COVID crisis and then dropped again. So the idea of actively managed versus passively managed in terms of the investment, yeah, but in terms of a person's portfolio, it day trading starts eroding everything. Trying to chase returns erodes everything. In terms of a portfolio, you have your risk and return. So every portfolio should have a little bit of everything in it. You have your stocks, which are your equities, the things that can create return. You have your cash, which is your liquidity, which is, that's your safety net. Cash will always lose value to inflation. Cash does not keep up with inflation. But hopefully the other investments make up for that. The cash is there for liquidity. Just like in today's day and age, millions of people unemployed. I'm an extremely conservative individual. So I will always tell people, always have cash on hand. Even if you have, hundreds of thousands of dollars in loans, I would tell you to always have 6 to 12 months of cash on hand. And if people are let go from their jobs, they have cash to make ends meet. If you have money in the stock market and that was the money you wanted to live off of and the stock market dropped, well, now you have less money available to you. So you always have to have a little bit of everything. I never believe in all in. Even when I would be considered by a lot of financial professionals to be, 20 plus years away from retirement, I still have a lot of money in cash, even though if you think about the conventional wisdom, I should be 90% in equities, which means 90% in the market. However, for my personal situation, my wife and I, we have 3 kids. We have other responsibilities if either one of us lost our jobs, I want to make sure that we always continue without having to feel stress. I would rather have cash on hand so I don't have to worry about stress. But that's my personal situation. Will it cost me in return? Yeah, of course it will. However, in loss of anxiety, I like that better. So risk versus return. So risk is return. The riskier something is, the higher return you will likely get. And you can't separate the two. However, you also have to think of it in terms of risk perception versus risk tolerance. And the idea is that you might perceive something to not be risky. Some people perceive rock climbing to not be risky. That is different than how much risk you're willing to tolerate. For instance, you might not think that rock climbing is risky, but you will not go up a steep cliff. Same thing with investing. Excuse me. You always have to think in terms of, people get into the market for greed, they get out for fear. So when the market's going up, everyone wants to get in because everyone wants to participate. The market will always go up. It's not very risky. The market went up for 12 years in a row. Yet when the market starts to fluctuate, people don't want to tolerate that risk. Therefore, they get out because now they perceive the market to have risk. And thinking about today's day and age, here's the Dow through May 20th or May 21st. You have volume, which is the trades made. The volume was going just fine, meaning that there wasn't a lot of activity. It was pretty boring, pretty stable in terms of market activity overall. Market was really high. All of a sudden, we start seeing the repercussions of COVID, and then activity goes up. Everyone's out there trading, and the market goes down. So again, these people did not perceive very much risk in the market. All of a sudden, there's a perception of risk, activity goes up, and then the activity remains high, and then it dips again. So you look at it in terms of consumer behavior and how people look at investments overall. You know, if you're saving for retirement, the idea, of course, is to set up your monthly contribution. And when the market's going up, yeah, maybe you're not buying as many shares as you think you should. But as the market goes down, you buy more shares. So again, prices are up, your contributions don't do as much. But as the prices go down with the market, you're still putting money in because you're buying at a discount. You know, it was, again, during the Great Recession where people thought we'll never come back from this. Yet 12 years later, we came back by a lot, even after losing what we did during the COVID pandemic. We're still higher than what we were, actually triple what we were. So always thinking that long term. Of course, as we mentioned beforehand, is that diversification. And this is something that a lot of people don't think about when they're looking at their investments. They'll say, okay, I'm invested in the market. I'm saving for my retirement. I'm going to buy Amazon, or I'm going to buy Google, I'm going to buy Microsoft. I have Microsoft, Google, Amazon. Maybe that's your portfolio. You have 3 different companies. But diversification is more than just the companies you invest in. Diversification is the sectors. You know, tech might not be doing so well, but you look at food or groceries, Kroger, you know, people are buying groceries right now, or you're investing in toilet paper right now, and those stocks are going up, whereas other stocks like for restaurants are going down. So the diversification is, you know, not just being in stocks and bonds, but also the different types of stocks and bonds that you can also be in. In terms of correlation, there's also something known as, in terms of diversification, there's also the idea of correlation. So if your investments are going up and the market's going up, your investments are directly correlated to the market. You want to have both correlated and non-correlated investments, positively and negatively correlated. So that if your entire portfolio is going up with the market, that means your entire portfolio goes down with the market. Versus maybe you have something like bonds, where when the market's going really high, bonds are not doing very much at all. But when the market goes down, bonds do better. There's always something there to counterbalance what one of your other investments might be doing. The idea of always to do this. You know, people talk about, you know, really steep returns. Steep returns usually lead with steep declines versus consistency. I'm a big fan of consistency myself. Also, correlation in terms of what types of retirement accounts do you have available to you. You know, the clients that have your IRAs, your Roth IRAs, your 403Bs, all the different types of retirement accounts that are out there, well, that gives them different, in this case, spigots to turn on and off. Do you pull money out of your Roth account? Do you pull money out of your individual account? Do you pull money out of your 457 account? Always something there. So with retirement savings, the government does have a role. And the government's role, of course, is Medicare and Social Security. And we can debate until, you know, the wee hours in the morning about where these programs would be in 10 years from now, heck, 4 years from now. This is the government's contribution to retirement. Your contribution is made up by what you put into your own retirement accounts. And an account, you think of account as it's the holder of the assets. The account is not what gives you the return, it is what holds your assets. And every account has its different pros and cons to them. So easiest way to explain it is when you think about in terms of traditional and Roth. And those are terms you get thrown around a lot. You might, especially if you read something like The White Coat Investor, hear about traditional and Roth. Traditional. What traditional means is you get your deduction now. There's a tax benefit now. If you have student loans and on an income-driven repayment plan, it affects your loan repayment because your loan repayment is based off your adjusted gross income. If you're investing pre-tax, your adjusted gross income goes down. But you pay taxes when you pull the money out. So save taxes now, pay taxes later. Roth account is the exact opposite. Sorry, you save taxes, pay taxes later. Here it is, a Roth, you want to pay the taxes now. You're saying, okay, I will take the tax hit now. My accounts will grow, and when I retire, I'll pull that money out tax-free. And if you're in residency, maybe a Roth makes a lot of sense because you're not saving a lot on taxes if you're putting money in pre-tax. But as faculty or further along your professional career, maybe you want to save the taxes right now because that is a big deal. So you'll do pre-tax and you'll pay the taxes at retirement when you pull the money out. Depending on your tax situation and depending on your overall situation, it's a little bit of both. Because when you go into retirement, you don't want to just have nothing but taxable income available to you. You want to have some tax-free income as well. So always looking at the balance. What will provide me, well, what will these accounts do for me when? And we touched on this a little bit already about, all right, so let's discuss pros and cons, right? 1% a year, 1% a year. Sorry, I'm not, 1% a year. Oh, are you talking about like I'm gonna have to, management fees. Okay, so we'll get to that one actually a little bit later, but we will get to that. And so, of course, employee retirement accounts, there's 4 4s. There's a 401A, 401K, 403B, and 457, which are just, there's 4 4s. And that's usually what employers have available to them and what you're able to invest in. So those would be your employer retirement plans. If you're looking at like private practices, et cetera, they might have SEP IRAs or simple IRAs, but they're just retirement savings vehicles. And each one will have their own benefits. So it is your employer match. So they give you money for putting money in. All of them are going to be tax advantaged. And the idea of it being automatic is if you set it up to where you have automatic contributions every month. Some employers you have to opt out because you automatically opt in. Others, it's not automatic. And again, the account is, it's the bottle that holds everything. It's not what gives you the return. And so always think of it like that, what account's better, the Roth or an IRA, which gives you the better return? Well, that's not what gives you the return. It's the investment inside. So again, how do you invest? 2 major ways, and this goes down to the fees. You do it yourself. Again, you go to Vanguard, Fidelity, heck, even when you set up your retirement account, yeah, there's predetermined investments in that retirement account at work, but you yourself can choose what investments do I want in that account? Which ones do I actually want to invest in? And so you can do it yourself, or you can hire an individual. And it comes down to individuals. There are 3 primary ways. You have fee for service, a combination, and commission. Excuse me, a lot of webinars today. So fee for service. This is getting to the idea of the fee, the 1% fee. So fee for service is typically done through what are known as registered investment advisors, RIAs. And they are professionals that will say, or entities that will say, okay, we will manage your money. We will charge you a flat fee every year. And that flat fee, I've seen it anywhere from $1,000 to $15,000 a year, or 1%. I'm used to seeing people who charge 1%, give or take. Some have minimum like annual fees. So I know an individual in Portland, and her minimum fee is $15,000 for the year. Doesn't matter how much money you invest with her, her fee to work with her is $15,000 for the year. If you have enough money under management to where her 1% fee covers $15,000, you'd have to have $1.5 million invested with her. Your fees from the investments would cover her annual cost. Then you have commissions. So commissions are going to be, you buy a mutual fund, a loaded mutual fund, or a commission-based stock trade. You go to what is known as a broker, and that broker says, okay, and brokers are usually like through banks, etc. They'll say, I work for free. You don't pay me any money up front at all. You don't pay me anything. You will never write me a check. However, they are compensated when you make a purchase. There is a commission. Like all insurance sales is commission. But with registered investment advisories, you can have it as a combination to where you have people who will say, okay, well, for our more affluent clients, we'll charge 1%. For people that don't meet our minimum investment costs, we will open up a brokerage account for them and we'll earn a commission off that sale. And when you're talking to a professional, it's always important to always dig into, okay, how are you compensated? What are you compensated for? What am I getting out of this? What's my return on this? Or, like for instance, fee for service, do you say, okay, well, hey, I want to make my own trades. You just tell me what I should invest in. I'll pay you your $200 an hour. You spend 3 or 4 hours on my stuff. I pay you $800. But that's all I'm going to pay you, and I'll just do it myself, and we'll see you next year. Versus I'm not going to pay you $15,000 for the year. That's literally the highest I've ever seen. Of course, keys to success. Always start early. Always get the match from your employer, definitely. The part about emotions is extremely, extremely important. And, if you're a person who will always worry about the market, that's something that only you can change. The market will do what the market does. And there's no way of timing it. There's no tool out there that does it for you. I don't care what the commercials say. You will never find that perfect thing. I mean, do you really want to spend the rest of your days staring at tickers and charts and graphs, and you do what is known as paralysis by analysis? You're waiting for that next bit of information to come out to determine what you should do. You'll never make a change. Nothing will ever happen. And definitely diversify. You have to make sure you have more than one thing going on for you. It cannot be locked into one thing. It can be a diversification through the different people you work with, the different professionals, the different opinions that you get. I mean, you think about it in terms of healthcare, you have your healthcare team. Okay, well, everyone has their own specialties. Who am I working with, and what specialty do they provide that helps me? I never believed that one person knows it all. Everyone's wrong. So how do you diversify not only your knowledge base, the people who are helping you? As for how to move forward, it's always taking that step back and saying, okay, well, there's a lot more to this than just numbers. There is. There's a lot more than numbers. There's a lot more than just putting money into retirement and opening up an account, just doing one thing. It's taking that step back and saying, okay, What is it that you're really trying to accomplish with everything that you are doing? What is it that you're hoping to see happen? What are those things you see coming in the future? And if you know those answers, then that also dictates how you act, how you invest, how you plan. Planning is not just putting money into a 401k. Planning is looking at all other aspects of life and then determining, okay, do you open up the Roth 401k or the regular 401k? Do you do the 457b plan instead? I know we didn't get down to the nitty gritty of what every single one of those accounts are, but again, it's more than just an investment. It's more than just picking the vehicle. It's seeing how those dominoes fall. Just like when you're coming up with a care plan for somebody, how will what we do today affect them tomorrow? And there's a lot to think about with that. But you have to start somewhere. And as you plan, as you adjust, as you look at what it is your goals and your needs are, then your plan starts to take shape. And a plan is not just a person telling you a number to save. A plan is a person telling you, again, how all those dominoes fall into order, how they will fall. Never look at a plan as, okay, well, your retirement plan is save $1,000 a month and invest in A, B, and C. No, that's not a plan. So as consumers, as you're looking at, how to, what do you do? Who do you work with? How do you work with these people? Always know that if a person just comes to you with a number is easy to create. The meaning behind that number is something that's harder to quantify. And so I know we ran over our time by a little bit. Any questions at all? And we're going into income and taxes, risk management, credit and debt, and of course, goals and tools and how, that talk about how do you look to the future? How do you plan for the future? How do you set yourself up and what do you utilize and how can you use it? So we'll be going over that a little bit later as well. So any questions? Oh, Roth IRA. All right. Is that at withdrawal? There's tax again. All right, hang on. Taxes are taken up front. Is that in withdrawal? There is a tax again, and you have to have the document papers showing the contributions every year from the time you started contributing to the fund, the J code. You pay the taxes up front, but when you pull the money out of a Roth, as long as that Roth has been held, so Roth has a few nuances to it. You have to have that Roth open for at least 5 years, and you have to be 59 and a half. At 5 years of having that Roth open, it's a qualified Roth account, and at 59 and a half, which is the magic retirement age that the IRS came up with, 59 and a half, your distributions are tax-free. Earnings, you name it, everything's tax-free. What would be considered taxable is if you take a premature distribution from your Roth IRA. So before 59 and a half, or before you had that 5-year mark of having that Roth IRA open. And so you can always take out your contributions without tax or penalty. So if you put $5,000 into a Roth today and it grew to 5,500, you could take 5,000 out tomorrow as long as you left your earnings in. But yeah, you have to have the documentation of what you put in so that when the IRS looks at you and say, how much did you take out? You can say, well, I didn't take out more than what I put in. So it is tax-free when you take it out. Should we all read or listen to The White Coat Investor? So while I was at OHSU, I had all of my students, I would recommend that they all read The White Coat Investor because it was very basic. And a lot of what he said, I agreed with. But you also have to think that, everyone's situation is going to be different. And I have an issue when people give carte blanche recommendations for everyone to follow. You just don't tell somebody, hey, everyone should be on. Sorry, I'm going to use terminology with repayment. Everyone should be on repay and done. No, everything is different. I think it's great to add to your knowledge base. Definitely. I mean, yeah. I mean, there's why he started it and what he did it for. I mean, one of the reasons why I went into academia. There's that unbiased idea of like, okay, what is it I should be doing? And you know, you always talk about an educated consumer and hearing different things from different people, and that kind of creating and molding your interpretation about what is right and what is wrong, what should be worthwhile. So I do think that you should read the book. Um, I'll never agree with everything he says, but just like with any professional in any career, not everyone's going to have that same opinion. Just like I don't believe everyone should refinance their loans. Interest rates are the last things I look at. I believe that they're going. I'm not sure about sending it out to the emails. I know this is being recorded, and that we'll get it out there. Actually, Joanne, thank you. It'll be posted. Definitely. But also, the Bogglehead Guide to Investing is also really good as well. And looking at the different blogs, Mr. Money and Mustache, Physician on Fire. There's a lot of great content out there from people who have experienced different things. That's one thing about finance, is that we all can look at finance, we all relate to that. But there's also something to be said. I mean, one of the terms that people use in finance is that, it's very easy to save money by doing your own open heart surgery, but you probably won't like the results. Investing's a little bit different. I mean, the information that a money manager will have in front of them, I guarantee you they got at the same time that you did, because one thing that I was reading every day when I was in finance, before my career took a shift, was I was reading, Yahoo Investor. I mean, everyone's on Yahoo Finance. It's a great site. But that's where, my bosses at the time were getting their information. Yahoo Investor, they plopped all their investments into Morningstar or Principia. Any consumer out there can buy that same program, run their same analysis. Different ways of thinking about it. But you also have to remember, like, is that what you want to spend your time doing? If the answer is yes, then yeah, go for it. If the answer is no, okay, well then you can get a second opinion. But it's still your life, and you do what you think is best for you. Any other questions at all? Not seeing anything else pop up. All right. Excellent. So thank you for being here tonight. Hope to see you again next week. We'll talk about income and taxes. And everyone, take care, stay safe, stay healthy. Thank you again.